Hey, welcome back to the Hub channel. I have Jeff here, the senior strategist at EWO Trader, and we're going to be going over a couple of trades that he did last week, including one of the best trades I've seen in a long time, where he absolutely crushed this thing. Jeff is also going to be showing us a couple of trades that he's looking at and a couple of trades that he's given subscribers specifically that are doing really well. Jeff, how are you doing today, and what do you have for us?
Brendan, I'm doing great. We're going to take a look at the markets, what's happening overall in the past week, and what we're looking for moving forward. I think that's very important since we're heading into earnings season. And then we'll talk about that trade that we found last week and where it went, and then we'll kind of close out with another opportunity of some possible trades going into the next few weeks. So a lot of stuff to cover in the next hour or so.
This sounds good. Let's get over this U.S. market update and hit those indices like we were talking about. I know we have some other things coming up. So,
Okay, great. Well, let's start with the Spider Index Trust. This is SPY, and you can see that the bulls are in control here. I mean, the bottom line, it's very clear. We've gapped up twice on the S&P, and the old adage is gaps are always filled, but the big question is when. We never know when. So even though the market has gapped up and left a little bit of wiggle room, these could take months or years to even be covered. So we're just looking at a market continuing to run higher. One thing that I like to do, and I did it last week, is change my candlesticks, which is what we're looking at now. These are daily bars, okay, candles representing each one. And I like to come over and use a different type of candle called a hike and a she. And you can see here that this really helps me identify a trend even better. All right. So as you notice on my chart is very clean. I don't have any moving averages on it. I don't have any oscillators, no MACD. I mean, I will use those tools and I will put them on. I'm a big fan of certain tools, but even in its purest form, which is price, okay, this is where Heiken-Ishii really comes into play. And right now I'm seeing green candles with no wick on the bottom of them. As you can see here, the wicks are only on the tops, and that indicates a very bullish market. Now you'll notice here back a few weeks ago in mid-June when we got these red candles, notice how they had no wicks on top, just wicks on the bottom, representing a nice orderly pullback. And then we got what I call a little wicky here with a day of indecision, couple of days of indecision, and then finally this run here. So this run right now, even with the gaps, shows a very strong market. And going into the next couple of weeks, this is going to be very interesting. And we'll talk about markets about that here in just a few moments.
no, while you pull that up, I
And
mean,
we'll
just
get it back
noticing
up here.
those candles there. How much room can you expect to go after those candle kind of give you that kind of sign where you have no wicks on the bottom and you see a couple of those in a row? How many more of those candles do you expect after that starts to happen?
You can get a bunch. I mean,
Okay. So you're in
it
it
can
for the
really
ride after
take
that.
off and run.
Yeah.
Yeah,
Okay.
you
Right
can
on.
really get a big move, and you'll see as we go through some of these. I'll put Hike and Ishii on once again, and you'll see how. In fact, I'll do it with the Qs when we get to the Qs. All right, so here's the Dow. Really double topping, getting close. It's where a few of our indices are breaking out, like Spider. Dow is being a little bit of a laggard here, but the true leader so far this year have been the Qs. And you'll notice an old area of resistance, which became support that I have down here. I'll take that off. All right, so let me put the Hike and Ishii back up here, and you will see that, I mean, look at these green candles here. I'll zoom in on it just a little bit, and just the run. And the key is when the candles turn red, doesn't mean to jump in the opposite direction. That's when you want to use things like moving averages or certain other technicals, maybe trend lines or other things before you go short, because these red candles, all they're representing are just gentle pullbacks on a big uptrend. All right, so the Qs, notice here back here, I mean, we had 5, 10, almost 15. So that would be 3 weeks in a row of an uptrend before just a little bit of a pullback. And then see 5, and then almost 2 weeks right here of an uptrend before sideways, and then another week up, and then a little. I mean, it's just it can go and go and go and go and go. All right. So again, we'll continue to float up until possibly we get through the next couple of weeks when companies start declaring earnings. You're going to hear that all through this conversation today. Here's IWM. And you'll notice here, this is what I talk about when we start getting a little wicky, okay? I've left my Heiken on for this very reason, okay? Notice back here where we had, let me just get a little, just right here where you have those bars right there. It became this is what I call wicky, where there's a wick on the top and a wick on the bottom. All right. Well, now you can see that we are starting to get that way once again with wicks on the top and wicks on the bottom. All right. So we want to we want to be cautious of a possible reversal in trend. All right. And that is something that we could get with earnings announcements. So when markets get like this and they start getting a little wicky when it comes to Heiken, that's kind of a warning sign, not a definite, but definitely, it's something to kind of look at. But as I showed you on Spider as an example, it's still, there's no doubt that the bulls are in control right now. So let's just jump on to some of the other sectors right here. Here was gold, and I need to kind of clean my chart up here. Notice that my areas, my wedges and my support and resistance lines, after a while, you just got to clean your chart up a little bit. This line, this horizontal line here, is off of a weekly chart. And let me put regular candles back on here, and we can see that gold, after gapping up several days in a row, just finally is starting to roll over and pull back. It came right up here to resistance 180 and 182. That range is proven to be a little bit of a resistance area for gold, and we could see it floating back down and testing support here right at 180 once again for gold. All right, so it was down just slightly today. Silver's been the one that has had quite a bit of volatility, as you see. This thing caught a bid and big gaps up higher. We would expect at some point for these to fill, but if we continue to roll over here, I would target 22 and then 20, believe it or not. Well, 20 is a little low, so 22 and then 21 for silver. All right, so it is at an area here of resistance. Notice what it's doing here. It is filling this gap back here that occurred in May, and it has only filled 50% of that gap. Okay, so is this an area where we are going to continue to run up and fill that gap completely? If you're a gap watcher, you got to be shaking your head. What do you do here? I mean, we have these to fill. We have this one back here to fill. I mean, look at this. We have this one back in March to fill, yet it hasn't even filled. So really what we're kind of looking at here is for silver to find resistance at $23, and if it breaks through 23, we could easily see 24, and that doesn't sound like a big move, but for something like silver, that is a big move. All right, so those are the metals that we really follow, gold and silver. Let's move on to oil. There we go. All right, let's clean this up a little bit here. We're back in the channel. You'll notice these little channel lines that I had on. We'll just extend these out. And this is a big channel that crude oil has been trading in, but it's tested the bottom. In fact, I could technically probably move that down and make this a little wider. But notice all of the action. We've been stuck in this big range. Even though there's been quite a bit of volatility with crude oil, it's just stuck between 60 and really $72, 72 and a half up here at the top. I guess that's a better area there. So 60 and 72 and a half. That's a $12 range that this has been stuck in, and that's pretty unusual for this long. It's been there for all year, stuck in that range. That leads to possibly some very good delta neutral trades. We have actually had at least 2 trades this year on USO so far, taking advantage of this sideways action. And when things get a little volatile and testing the upper and lower, it makes for even more opportunities within a instrument like USO. So we love trading USO. It's kind of one of the things why I watch it. And we also watch natural gas, which right now is just, I mean, notice it's trading in a range now too, but you saw that big drop. Okay. And then it's just traded this big drop, and now it's just trading sideways in a range. And the thing about some of these stocks that get stuck in this range, and in this case it's an ETF, is the option pricing adjusts to that. And when you have what this is actually called low volatility, meaning low statistical volatility, and pricing adjusts for it. All right. So there's sometimes really no opportunity, but things change, and that's why we always keep them on our list, on our watch list, is kind of keep a quick eye on them. All right, onto the bond market now. We have BND. This is a ETF that covers really the entirety of the bond market. And I'll just refresh that real quick, as I believe we are updating in prices.
Yeah, I think Google's still up there. But I noticed with those, with all those, the crude and everything else that's trading in those ranges there, is that something you're actively still trading in those ranges, or are you more waiting towards the tail end of those ranges to wait for like a breakout of that range?
Oh no, we trade we love the ranges, and because they're very predictable.
Okay. Yeah.
And we'll trade strategies that take advantage of it, just trading in that range. Those ranges frustrate the dickens out of owners of these ETFs. And you can see here the bond market has been going sideways, trading in a range. And one thing to notice here is my scaling on the right hand side of my chart here. Notice this is in $1 increments. And one thing, as an old type of trader, old school trader, I like to adjust mine to where they're either in 250, which you see here, or even $5 scaling. And if I scale this down to $5, look at that for BND. That is my scaling is in $5. So every $5 there's a line, 70, 75, 80, 85. And when you do that, look how just quiet the bond market is. And so we keep an eye on this. Is there a possible trade? Because this thing is trading between whatever price, whatever 2 prices. And we follow that quite a bit. And I'm pulling up right now a yield spread chart real quick, because we want to follow what's going on between the 10s and the 2s. All right, so let's jump here to TLT, and you can see I had this trend line up, and then last week we started to break down below it. And look at this, we have retraced now just a little bit of that move. We have probably retraced about 50% of that move, and I'm just going to pull up my little fib retracement tool here. We'll get a little reading on that, and 61.8. So we're right at that 61.8 retracement, which we could expect then another continuation down on TLT, which means interest rates continuing to rise. All right, now SHY is the short end of the curve, and that is the really anything that's 1 to 3 years in time. But here's what I wanted to show you. Let me pull this up and put this on the board. This is the spread between the 2s and the 10s. We dipped below 100 basis points about 2 weeks ago on July 3rd, and now we've rallied up. The spread narrowed slightly, but we're still at negative 91 basis points. That means the 2-year, in this case, in this example, the 2-year are paying a much higher rate than the 10-year. Okay, and then we can see that really here when we go to SHY, and the bigger moves that the short term, in this case, it's the 1 to 3 year Treasury bonds. That's what this ETF is, SHY. You can get an idea here. When you overlay those two charts, you can get an idea of the spread either widening or consolidating. And in this case, because of that, as you saw, we're really close to 100 basis points. That is recessionary. Okay, that inverted yield curve, it causes all sorts of problems in the credit market. Now, you may think, oh, well, I'm not affected by the credit market. Well, everybody's affected by the credit market, whether you're trying to purchase a new home or a new car, or get a line of credit, or the interest rates on your credit cards, or trying to get a credit card. It affects everything that we do. All right. And so that inverted yield curve, as long as it's there, that is one of the big dark clouds that is overhanging this market right now. All right.
What's
Lastly,
what?
we'll touch on the VIX. I'm sorry. Go ahead, Brandon.
Oh no, I mean Jeff, this is kind of what I was kind of lean into is how much does the macro picture, how much does this play into what you're looking at? I mean, obviously we've been living in this kind of euphoric phase as we come out of COVID. Things were good, things were sunny and stuff, but the market's been holding really well right now. When do we got to expect that dark cloud that's on the horizon that we keep hearing about? When are we looking for that type of thing?
Well, that's the thing. We never know. And the charts, that's why you should always let your charts tell you direction and give you an idea. Here we have the VIX. It was up slightly today, 135 basis points, but look how low it is. It's trading at 1352. Oh, let me zoom in on this a little bit, and you can see here it's trading in the teens. We did have a little spike up last week, but then we quickly dropped back down, and it's back down near here support. And as long as the market keeps going up, we could see the VIX drop to 12 or 11. And that old adage, when the VIX is low, it's time to go, that keeps rearing its ugly head. Now, when you should go is always the question. And it's as simple, believe it or not, as drawing a line in the sand. That line in the sand, like say it's on the S&P 500, so we could use Spider, okay? And let's pull Spider back up before we move on here in just a second. We'll pull Spider back up. And sorry, when I refresh, Google's going to come back up, but I'll jump over to SPY. Google's my default stock here, so we'll pull up SPY. All right, now, one thing I don't like about this rally is the angle of ascent. All right, and I think I've talked about this before, but if effectively you get these moves higher. I think I showed this previously, and you kind of come over and you can match these rallies through this angle. But then all of a sudden you come over here and you do it again, and you get this sharp little rally that starts to get above. We would anticipate a pullback at some time. Now, what I would do is simply put maybe some moving average on, like a short term, either a 10 or a 30 day. I personally use a 21-day moving average. That's what this red line is here. And notice right now how far we are away. We came down and we kissed that 21-day, not just once, but twice here within the past month. This rally just took off from it. what I would say is, hey, if we get a definitive close below a 21 period or whatever your study is, then you prepare for a market pullback. And right now, we're just not seeing it. Your short-term moving averages are pointed higher. Your long-term moving averages pointed higher. It's a bull market. It's a bull market. So where
Well,
that
there's that. Well, well, I know we're living in a bull market, but let's do something that I know we like to do every week. Let's go ahead and let's go over the past couple of trades that you went over, including that one last week that you gave us, Jeff. That one trade
yeah.
that has done so well. Tell us about that trade.
Well, okay. So, last week we did a trade on. Well, let me pull it up here. Well, this is the trade that I was going to highlight for today that just recently closed out. My apologies, but let me pull back up. All right, here, XLU. All right, this is the trade that we put on last week for everybody. I was going to show you a highlighted trade. I'll get to that trade in just a moment. Didn't realize I had it open in 2 tabs, but this is the trade we did last week. It just in 1 week, okay, we have doubled our money in this trade. Okay, this would be an ideal day to take this off. I did, as you can see in this example, a hypothetical 12 contracts. Okay, remember our trade last week was $16. Okay, that's very low. Times 12, if we did 12 contracts, is only $192. On a hypothetical $10,000 account, that's 1.92% risk to portfolio. And now today, in 1 week's time, we have generated $200 on our trade. That's a 2% return on portfolio in a week. Okay, and we still, look at this, our short-term option doesn't expire for 18 days. Now, remember, this was a calendar spread. And if you're not sure how calendar spreads are established, we go out in time and we buy a long-term option. In this case, we bought the expiring August 18th, the 65 strike puts on XLU, which is utilities. Okay. And then to help finance that put, we sold a nearer term option, which happened to be the August 4th expiration. This is a weekly option. And we sold that 65 strike put. Same strike, but different expiration dates. Okay. Known as a calendar spread. Now, 16 cents, you're not going to really find a trade cheaper than that. All right. I've been finding a ton of calendar spreads for very little money. And you'll see here in a minute why I get so excited about some of these, because some of the trades I'm going to show you in a minute are much more expensive, but can also pay off big. And that's what I'm going to show you in just a second. But for right now, since we're talking XLU and we're talking this trade that we gave out a week ago, you could do a couple things with this. The most conservative route is to just close out the whole trade. And how you close a calendar spread is you buy what you sold and you sell what you bought. Just reverse the process that you did to get into the trade. That's how you get out of the trade. Okay, so in this case, we would buy to close the August 4th 65 strike put, and we would sell to close the August 65 strike put. Notice they both have value to them. Okay, and so we would put in our order either as a market order or a limit order. Usually when I'm exiting a trade, I like to do them at market orders just to kind of lock in my profit. In this case, it's a very nice profit, and then move on. So with this, you have a choice. Because we did 12 contracts, you could close the whole thing. That's probably the easiest way to go about it. But if you felt strongly that XLU was going to retrace and retest 65, which has been this area of support, okay, that is right where our strikes are, and that is where the maximum reward is in this trade. Now, if you notice in my information up here, and I have had it highlighted here, maximum profit on 12 contracts is over $600. We've only captured $200 of that 600. Now, I'm not really greedy. I would probably go ahead and I might wait a day. Well, markets are closed now, so hypothetically, I'd wait till tomorrow to see what would happen. But if XLU dropped again tomorrow, I would definitely be closing this. Now, the alternative is, since you've got 12 contracts, is to close out a portion of your position. Now, let me talk to you about this. I have heard literally 100% of the time, traders say, close out of half of your position and leave the other half. And that way you'll lock in a no risk trade. Well, that's not true. And why anybody would take off half of their position and leave half is beyond me. I would take off maybe 8 or 10 contracts that would lock in a profit, okay, and then let the rest run. So what could happen if you take half off? The underlying stock could move against you, and then you would lose all your profits and you would break even. Well, quite honestly, Brandon, I'm not in the business of break even. So I want to capture a majority of my profits. In a case of 12 contracts, I'm going to take off 8 or 10 of them and leave maybe a little bit to capture some additional profits if possible. Otherwise, I'm closing the entire trade. Now, this is the type of information that you get when subscribing to our Delta Neutral Trader newsletter. Subscription-based service that we send out trade alerts every week. We send out actually multiple trade alerts every week. And Brandon, unless you have any questions about this trade, I'll just talk about one of our recent winners. How does that sound?
Yeah, let's go on with it. And I like that mantra that you have there. You might as well take a profit off the table along with everything else that you're taking off the table, because I'm with you. Why take off half and then hope for a break even at the end of the day? Take off some profit. Then you made money on. Then you're really playing with house money on the trade. But Jeff, congrats on that trade. 100% win in 1 week is pretty good.
Isn't that amazing? Yeah.
And and I'm just from Idaho, and that doesn't happen. That was a good win. Yeah, let's get on with this next trade that you want to talk about here.
Okay, well, let's jump in and take a look here. As you know, we highlight trades. Recently, we took off our Brinker International trade. Now, this was a iron condor, and the reason why I'm featuring this trade today that was recently exited is because it was not a calendar spread. We highlighted some trades last week. We did a calendar spread with XLU, but I wanted to highlight a different type of delta neutral trade, and that is an iron condor. Now, this is an advanced strategy, and when we say advanced, it's only advanced when you're new to options and haven't realized that really there's only 2 things you can do with options, and that is you can either buy them or sell them. That's it. You either buy them or sell them to open, and you either buy them or sell them to close them. Okay, and once you kind of get that footing, then trades like an iron condor become a little easier to digest. So let me jump in here and show you what I was seeing when we entered this Brinker International iron condor. The symbol is EAT, and this screenshot that I have open for you right here is a picture back on June 6th when the trade alert came out. So let me jump back here. You can see entry date down here on this line, 6/6. All right. We did 1 contract at $1.82 credit. All right. So this is the chart. Notice the sideways channel here. We're already past earnings. The stock continuing to trade sideways. So we put out our trade, $1.82 profit. Now we were risking 3.18% on portfolio, $318. That's why we did just 1 contract. Okay. And this was a combination of buys and sells. All right. In this case, we bought the 45 strike call. We sold the 40 strike call, both expiring on July 21st. And then on the put side, which kind of made the bottom part of our iron condor, we bought the July 21st 30 strike put and sold to open the July 21st 35 strike put. You combine all those legs. So we're essentially selling a call spread and selling a put spread. Both of those generate a credit that totaled $182. Now, let's jump forward to when we were beginning to exit. All right. Now, July 3rd is when really we got to a point where, hey, we need to take this off. But that was a quiet trading day right ahead of July 4th. Okay. It was a shortened trading day, not a lot of opportunity. But look at our trade now. Okay. On July 3rd, this is when we were getting ready to prepare the order to exit the trade. We had, look at this, a majority of the profits, the max profit we would have is $182. We already had $168 of that 182 with 18 days. See this day column right here with 18 days left. Okay, it is time to exit this trade. All right, so we jump ahead to the 5th, and that's when the order went out. And you can see here all legs are closed. And we ended up, because prices move up and down, with $131 of profit in that trade. That's a 1.3% return on portfolio in a month. Now, think about this for a second. We had Brinker International generate 1.3%. Now we just had XLU generate 2% because it has a $200 profit. All right. And we're doing these, over and over and rinse and repeat and rinse and repeat. And as long as we can keep our losses consolidated, then we're going to be, we're going to have an incredible rate of return. Now, what I wanted to show you here is just our last several trades. Okay, I'll highlight probably next week. We'll highlight Foot Locker. That was one of our most recent wins, but you can see here of our past 5 or 6 trades, win, and you get these where you can calculate, okay, $100 profit, $100 profit, 1.131, 288, 180, 117, 152. You get the idea? Hitting singles, hitting singles, hitting singles. Well, the Campbell's soup, as we talked about last week, I consider that a double. Okay, maybe even heading to third base on that one. And as long as we keep the risk in our trades small, then we end up generating incredible monthly returns. So,
Jeff, you've been on a
Brandon, I heard you pop back on.
Yeah, you've been on a streak lately, and I know we've been talking about this for a couple weeks now. We've seen kind of your wins and what you got set up. So I think what everybody wants to know now is what's next. What are we looking for?
Well, now we're looking for really the headline risk of earnings. Do you happen to have that snapshot of the Jeffries comment up? And if not, then we can.
Oh, that's the that was the dark cloud one. We put that up a bit ago. This is the dark clouds ahead. This is kind of like what you're talking about. It's coming up for the economy. Yeah, this is.
Yeah, I was talking about. Yeah, sorry, I was focused on my screen and didn't see what you had put up earlier. But yes, absolutely. Yep. We're kind of looking at earnings, and what I have for you here is a list. If you can go ahead and put up that list of upcoming earnings. Now, the top line are earnings this week, and you can see that we have quite a number of stocks, but it's really the week after. So next week, when we really get into the meat of earning season. And because of that, there's a certain delta neutral strategy, actually 2 of them, that come to mind when we get into earnings season. Now, stock behavior is it's a study within itself. Is that how do stocks behave around an earnings event? Believe it or not, we do sideways strategies into earnings with regularity. Okay, even though there's an earnings event coming up, it doesn't bother us. Why? Because the stock has historically shown that it doesn't move around earnings. However, there are certain stocks that do move around earnings. And boy, do I have a treat for you today. All right. Can we bring up the list, or do you have it up already? I have a list of stocks that have exhibited the statistical volatility, meaning big movements going into earnings. Out of the last 6 earnings announcements, these stocks that you see right here have either a 6-0 record, meaning 6 wins and 0 losses, or are 5-1, meaning 5 wins, 1 loss, utilizing the strategy that I'm about to give you right now. Okay, so tremendous opportunity. In fact, let me pull up that stock there that we have highlighted, OMC, and it is a stock that has earnings coming up in a very short period of time. And you can see that this stock has been, boy, on a big move, big, strong stock. It's currently trading at $97. And the strategies that have won are either 6 times or are 5-1 out of the past 6 earnings announcements are straddles and strangles on this particular stock. Okay, so we wouldn't trade necessarily a sideways strategy like a condor or iron condor or a butterfly around an earnings event with this particular stock, because its earnings dictate that the stock does show some statistical volatility, meaning the big price movement going in advance of earnings and after earnings. And one of the reasons that this came up was because the strategy actually showed a very good price. All right, and that strategy would be a straddle. All right. Now, a straddle is buying an at the money call and buying an at the money put. You buy those at the same time, and that is a straddle. The stock has a potential to make money if it either moves up or down, but would lose money if it just goes sideways. Now, a strangle is buying a call at one strike price and then a put at a lower strike price, buying both of them. That would be called a strangle. 2 different strike prices, same expiration. It's a little less expensive, but the stock has got to move more. So there's a great trade possibility for you. Now, usually straddles get to be hundreds of dollars, if not even thousands of dollars for certain stocks. All right, that's why they are more expensive strategies. And I really only utilize them, for me, only around earnings events when the possibility has increased for a move that would actually generate some profit for me. So straddles and strangles are one of the basic strategies that people learn about when they first start trading options, and they are a delta neutral strategy. So that's what we're looking for today, is with upcoming earnings, we have the ability to possibly make profit either up or down with either an up move or a down move in the stock. We just want it to move. So how about that, Brandon?
Yeah, I mean that makes sense. So we just need volatility right now, and that's going to help with the trade that you have planned coming up here. I like that. And especially,
So
is that a concern when we looking at you were talking about the VIX earlier, approaching make all-time lows. Is that
right?
Does that something that we look at together with this? What you have planned here?
No, the VIX is kind of an overall viewpoint of
Okay.
the broader market. Okay, we're looking at individual stocks which have their own levels of volatility. All right, and specifically, near-term options start to get a little pricier when we go into an announcement like earnings events. There's other reasons, like on a biotech stock, there might be a pending FDA announcement that might cause implied volatility to rise. But here it's going to be an earnings event, and OMC has an announcement coming up, and that's why we would place this type of strategy going into that earnings event. So I'm looking at an at the money straddle. So find the nearest to the money, call and put, and there you have your straddle going into earnings.
Okay, I
Now,
like that, Jeff. That makes sense.
when you want a little hand holding through these trades, that's why you should subscribe to our Delta Neutral Trader service. All right. I want to jump back to the Brinker International trade for a moment and highlight. We highlighted the entry that we had here on June 6th, and then here was our exit instructions on July 5th. But I also provided commentary on this trade. Okay, why we were exiting, what to do, specific instructions. So when you subscribe to our service, that is one of the advantages of the services, that we isolate a particular stock, we isolate the strategy that goes with the current market environment, we provide you commentary, we provide you entries and exits. And so to sign up, we have a page, which Brandon, you can pop that into the box. You can subscribe to our Delta Neutral Trader service. We'll be updating this performance tracker record on a regular basis and showing the performance. You see, we had an incredible run up until a little bit of a drawdown, and then you're going to see that line starting to shoot up once we get in through the rest of July, because we just recently closed out a lot of those winners. You'll see that number shoot up once again and probably reaching new highs. Okay, so right now we're running 63% winning trades. Did you know I could actually make huge profit only winning 50% of the time if I know how to close out losers? If I can control my losses and let my winners run, I can make money with only 50% winners. But right now, that number is going to go up 63% at the time of this snapshot. Average trade percent return on investment was 15%. Great numbers for this type of service. So I would hope that you would join me when we find opportunities like this that come up. Earnings happen typically every quarter for most stocks. And so we have this opportunity on a regular basis, on a regular cycle. So we'll watch out and see. We'll track what Omnicom does over the next couple of weeks going into earnings, and let you know the progress there, and see if we have our second winner here on our Trade Finder Live here with Delta Neutral Trading. So Brandon, that's pretty much it for today. Any other remaining questions?
Man, thanks so much, Jeff. No, that was a ton of insight. And just like Jeff said, by all means, there's a link right now on the screen. You guys can go ahead and check that link out. That's where you can sign up for a free trial of Delta Neutral Trader. Also, I will put the link in the description so you guys can just click on that bad boy and get right on over there. This is a wealth of information, but not only that, like Jeff talked about, you get trade alerts, you get trade strategies, you get some hand holding, as Jeff puts it, which is something that I usually need in my trades and other things like that, because I don't like to go it alone. But this is step-by-step stuff to get you guys introduced into strangles, straddles, butterfly trades, iron condors, any type of calendar spread that you guys could dream of. Jeff knows his stuff, so we appreciate that, Jeff, and we look forward to next week where we're going to hear more of this information.
Great. Well, it was great. Thanks for being here, everybody, and we will see you next week, next Monday, same time, same place. Everyone have a great trading week.